Hi, I'm Steve. I'm going to share my thoughts on how you can achieve a better financial future. Please remember, I don't know anything about your situation, so think for yourself and use what fits. Debt is often believed to be a less risky alternative to investing in the stock market. It turns out that this might be true, or it might not. It all depends on the type of debt or stock you purchase. Overall, both stock and debt investment alternatives range from very conservative to wildly risky. Remember that the riskier the debt, the higher the expected return should be. As an investor, you're looking for a good deal at a risk level you're comfortable with and that fits within the rest of your portfolio. Let's take a look at the three main risk areas for debt. The first one is the maturity period, or how long you have to wait to get paid back. The longer the period, the greater the risk. The longer you have to wait, the more chance something bad could happen. Inflation could run wild. The debt issuer could go bankrupt, etc. In some cases, the debt may also be difficult to sell before maturity. If an unforeseen need for the money pops up, you might be out of luck or have to sell at a deep discount. A second big risk factor is the creditworthiness of the issuer. This judges the risk of not getting your money back. Credit status is a big factor and ranges from the U.S. government to your Uncle Fred. Slightly above Uncle Fred are issuers of junk debt and private loans. The interest rate you receive is strongly correlated with the risk. In my opinion, no amateur should invest in private debt. This debt is not traded on the public markets, it's not rated by S&P or Moody's, and is usually very hard to sell before maturity. Stay away and don't be tempted by sometimes crazy high interest rates. Corporate debt is usually rated and tradable. It covers a wide range of issuers, ranging from super solid to a bit sketchy. The biggest valuation driver of high yield or low quality corporate debt is the health of the economy. When things are good, most issuers can pay. Hit a deep recession, and many more defaults will occur, which of course drives prices down. Finally, we have our third risk factor, interest rate risk. What do you think interest rates will be next year? How about 5 years from now? How about in 20 years? If interest rates rise while you own debt, the value of that debt will drop. Let's imagine you buy a 10-year government bond that pays 3% interest. A year from now, interest rates suddenly double to 6%. You now have two lousy choices. Accept 3% interest when every new bond pays 6%, or sell the 3% bond at a big discount. Well, that's it for this session. Thanks for watching, and I'll see you next time.